The Federal Reserve, the central bank of the United States, has always been more than a domestic institution. Its decisions shape the global cost of capital, the direction of trade, and the stability of financial markets. Independence from political interference has been its defining strength, ensuring that monetary policy responds to economic fundamentals, not electoral cycles. But today, amid rising populism, political polarization, and pressures from both Congress and the White House, the Fed's independence is being questioned more openly than at any time since the 1970s. The Federal Reserve holds a balance sheet of more than $7 trillion, swollen by years of quantitative easing. U.S. federal debt exceeds $34 trillion, with annual interest costs surpassing $1 trillion, making rate hikes politically sensitive. Inflation peaked at 9.1% in June 2022, the highest in 4 decades, forcing the Fed into aggressive tightening. By 2025, the Fed funds rate remains above 5%, a level unseen since before the 2008 crisis. Polling data shows more than 50% of Americans believe the Fed's policies favor Wall Street over Main Street, eroding public trust. These numbers highlight the tension. The Fed is tasked with controlling inflation, but its tools impose costs that political leaders cannot ignore. The struggle over Fed independence is not new. In the 1960s, President Lyndon Johnson famously pressured Fed Chair William McChesney Martin to keep rates low during the Vietnam War. In the 1970s, President Nixon leaned heavily on Arthur Burns to maintain easy money ahead of his re-election, a choice that contributed to runaway inflation. The turning point came under Paul Volcker in the 1980s, when the Fed raised rates above 15% despite fierce political opposition, restoring credibility but at a severe economic cost. History shows that independence must be defended. It is never permanently guaranteed. A turning point today is the growing willingness of political leaders to question or even threaten the Fed's authority. Former President Trump openly criticized Fed Chair Jerome Powell and floated the idea of replacing him for not keeping rates low. In Congress, both progressive Democrats and populist Republicans have proposed legislation to subject Fed decisions to political review. This is not just noise. It reflects a deeper skepticism of technocratic institutions and a willingness to subordinate monetary policy to short-term political goals. 3 systemic pressures define the challenge. Debt sustainability. With U.S. debt rising, politicians have strong incentives to pressure the Fed into lower rates to reduce financing costs. Partisan populism. Both left and right increasingly portray the Fed as unaccountable, eroding institutional legitimacy. Global interdependence. Because the dollar is the world's reserve currency, any perception of a politicized Fed undermines confidence in global markets, amplifying volatility far beyond U.S. borders. The Fed is thus squeezed between domestic politics and international expectations, with its credibility at risk on both fronts. Looking forward, 3 systemic scenarios lie ahead. Baseline scenario. The Fed maintains operational independence, but political criticism intensifies. Credibility erodes gradually, but the institution continues functioning, albeit with weaker public trust. Stress scenario. A populist administration attempts to impose direct control, firing or sidelining Fed leadership, or legally curbing its mandate. Markets panic, U.S. borrowing costs surge, and the dollar's reserve status faces its first real challenge. Reform scenario. A bipartisan recognition of the risks leads to renewed protections for Fed independence, possibly codifying greater insulation from political cycles. This restores confidence but requires rare political consensus. Each path hinges on one question. Will political leaders accept short-term pain for long-term stability? The gravest risk is not immediate policy missteps, but the erosion of credibility. Once markets believe the Fed responds to political orders, inflation expectations become unanchored. Investors demand higher yields to hold U.S. debt. The dollar's role as the world's safe haven begins to fracture. Independence is not just a procedural principle, it is the backbone of global financial architecture. If that backbone weakens, the consequences cascade worldwide. The Federal Reserve's independence has long been the foundation of global monetary stability. But rising political pressure, debt dynamics, and populist distrust now threaten that foundation. The question is not only whether the Fed can withstand interference, but whether the world is prepared for a future where it cannot. If strategy, history, economics, and finance shape the world, this is where they converge. Subscribe now and join the conversation.